Hi, everyone. This is Jason Burek of Wall Street from E Street. Welcome back to another Wall Street from E Street podcast interview. Today's special guest is a returning guest. He's a former successful technology entrepreneur. He's a hedge fund manager. He's host of the popular and rapidly growing Macro Voices podcast, which is for sophisticated investors. And he also has a new book coming out soon called Beyond Blockchain, The Death of the Dollar and the Rise of Digital Currency. Erik Townsend, thank you for joining me again.
Thank you, Jason. It's a pleasure to be here. And as we speak today, the book was released, so it's not coming out soon anymore. It's out.
And you have it on audiobook as well. And listeners to our podcast will be happy to learn that Erik was gracious enough to give our listeners one free chapter of the book. So he'll give out the link later in the interview.
Alrighty.
Okay, so Erik, let's start off this interview before we talk about your book. Let's talk about the dollar. So at the end of last year, in 2017, you had this dollar roundtable, and there was a lot of good content on there, a lot of good analysis. A lot of people are long-term bearish on the dollar, but we've had basically the entire year of 2018, this enormous dollar rally. The dollar index, when we're recording this interview on Thursday, November 15th, is at 97.8. It's been just on an absolute tear. It broke above overhead resistance levels at 96 and 97. It was stuck at 96 for a while. I don't see any evidence that the dollar rally is over. So what are your views on this, and how much damage do you think the dollar is doing right now, and how much more damage could it do if this continues?
Well, we got a few questions there. So first of all, the dollar roundtable that we did at the end of last year, what we have seen is very much consistent with what some of our guests predicted, Jeffrey Snyder in particular, saying, look, it's not good, it's not healthy for the dollar, but what we're going to see here is a squeeze higher. Dollar index is going to move higher, and this has been very much my view as well. What I think is going to confuse a lot of people is they're assuming, oh, it must be, the U.S. economy is just wonderful and everything is great. Well, part of it is the differential in Treasury yields, that U.S. Treasuries return a better yield than any of their competitors do, and that is attracting capital, and that's resulting in the buying of dollars. But more than that, it's a much more sophisticated and complex situation that involves a large dollar short that's being covered. And I don't mean a short in the sense of somebody selling short like a speculative trade, but rather there is just so much short exposure in the financial system to dollars, and the euro dollar system is not supplying sufficient dollars anymore. So there is a dollar scarcity problem that's global, and it's going to get worse. And I think that what happens from here is the dollar index will continue to appreciate against other currencies until they do something intentional to fix it or to change it. And that could come just in the form of the Federal Reserve changing its stance. The reason we've seen all of this recent strengthening of the dollar is because the Fed has been hiking interest rates. Higher interest rates means more foreign capital is attracted into U.S. Treasuries. In order to buy those U.S. Treasuries, they've got to buy dollars first. So the mechanism there is the rate differential on Treasuries versus German bonds and other sovereign debts around the world. I think that is going to continue, but if you were to predict, say, that maybe the stock market really starts to get into trouble, and we can talk about that separately, but if you think that we're coming into a bear market in the stock market, is the Fed really going to stay true to what Jay Powell has kind of intimated, which is, hey, we're not in the business of bailing out the stock market. We're going to continue to administer monetary policy based on the economy without concern for the stock market? Or are they bluffing and they're really going to bail us out? If the Fed changes its direction next year and turns dovish and starts cutting rates again, that would put a halt to the appreciation of the dollar. But until something happens to change the fundamental drivers that are behind this, I don't think there's any reason for it to stop anytime soon. It would be a change in Fed policy or some Plaza Accord type of intentional central bank decision that the dollar appreciation was causing too many problems around the world and they wanted to arrest it. The one thing I would say is President Trump has been pretty outspoken saying he would like to see a lower dollar. Now, At the same time, a lot of his other policies are very dollar bullish. So it kind of doesn't make sense. It's political stuff. Does he really mean it? Is he going to really get on the Treasury Secretary and the Fed's case if the dollar continues to appreciate? It's good sounding politics. Is there really anything behind it? I guess we'll wait and see what happens. But until somebody takes decisive action, I agree with you. The dollar is going to continue to appreciate.
And besides these rate hikes, do you think another reason that the dollar could be appreciating is because there's actually a lot of evidence now that the global economy is not doing as well as a lot of these governments were claiming? So we've seen when we look at foreign stock markets, besides the US stock market, and the US stock market has been very volatile the last month. October 2018 was one of the most volatile stock market months in 118 years of data. But a lot of other stock markets, especially in other major economies, those stock markets are below their 50 and 200-day moving averages. So basically, then they're textbook definitions of a bear market. So do you think then that besides just the Fed hiking rates, that a lot of money, a lot of capital was coming into dollars, a lot of capital was coming into stocks here in the US because it was flight capital that was leaving these other economies, these other markets in other countries?
Yeah, I do, but I would say I don't think it's necessarily flight capital from other countries flowing into the U.S. stock market. I think it's flight capital that is flowing into U.S. Treasuries, because if you were invested in European stocks, if you're a European institution, and your choice is to go into zero yielding or even negative yielding bonds, or to go into U.S. Treasuries, you're going to go into U.S. Treasuries. And so it's flight capital from the rest of the world, but it's flight capital into the U.S. bond market, not into the U.S. stock market.
And speaking of the U.S. Treasuries, the 10-year, Jeff Gundlach has talked about 3.25 being the key number, and it has to close above there for a number of days in a row for the rout to start. But it seems every time it either gets to those levels or close to those levels, it just gets whacked back down. We're at 3.12 right now on the 10-year U.S. Treasury. So do you expect then it's stayed basically in a range? Once in a while it goes above a certain range and then it gets whacked back down. Do you expect things to kind of stay in that range for a while still?
Yeah, the range that we've been in, there was for a long time, the number was 3.10, 3.12, something like that on the 10-year. We broke through that all the way up to 325. Then we came down and we've tested that same 310, 312 level as support. From there, we went back up to that 325. And if you saw it go higher to a new high, that would really tell you a trend is in play. We didn't get that. We're going bouncing back and forth between 325 and 310. Well, one of those is not going to hold, and we're either going to move higher than 325, or let's give it a little more room than just 310. Let's say below 305, or a closing print above 325. When we see either one of those things, it's probably a much more decisive clue that on a closing basis that there is a new trend in play. Almost everybody has been convinced that it's going to resolve to the upside in yield, downside in price, that we're going to break through 325 and move to even higher yields. The thing is that, as several people have pointed out, you go past 3.50 or so in the 10-year, and all of a sudden, a whole lot of debt just becomes unserviceable, and it breaks a lot of things in the U.S. economy and around the world. So can they really allow it to get to that point? And is there a governing cycle where, as it starts to get to that point, it results in so much contraction in the rest of the economy that rates naturally come back down because of that contraction that's being caused? So there are a lot of feedback loops. I am probably going to say that if I had to guess, the lion's share of the evidence has been that we're moving toward higher yields. But at the same time, I think there's a very good case here that maybe 325 contains it. If we see a move below 305 on the 10-year on a closing basis, that would really cause me to think, maybe usually the more people that are certain of something, the less likely it is to be true. And there's just so many people that are sure we're going higher than 325. I wonder if it's a self-fulfilling prophecy.
And eventually, the bond market has to react to the exploding budget deficits that the U.S. government is running. And you combine that with the fact that the Federal Reserve has been selling a lot of assets, ramping up in their QT program. So I think we're almost to $4.1 trillion on the Fed's balance sheet. It was a little bit above that. So that's almost $400 billion in asset sales since the peak, I think, I forget the exact date, but it got as high as $4.5 trillion. So we almost have $400 billion total in asset sales. Sounds like a large number, but relative to the size of the balance sheet, it's not really that much. But if the Fed, Donald Trump, I was seeing this when he was campaigning, that he was talking about basically supply side economics with his tax cuts because he didn't promise any corresponding cuts in government spending. But when I interviewed people like Paul Craig Roberts, who was Assistant Treasury Secretary in the Reagan era, he was considered, one of the fathers of supply side economics. He tried to claim to me that supply side economics is deflationary because it's going to create more supply. Well, in theory, maybe the textbooks will say that, but in reality, though, the U.S.'s debt to GDP when the U.S. was last running supply side economics with exploding government budget deficits was below 40% debt to GDP. Things are different now. So I see inflation and stagflation coming soon. And do you think then the Fed is going to probably reverse that QT? Because who's going to buy the treasuries then as these government budget deficits explode? I don't see foreigners wanting to buy more and more treasuries, especially with the evidence we're seeing from the Chinese government. The Russian government, I think, is down to almost zero treasuries. China has dumped some, but I just don't see evidence that there's enormous demand for increasing appetite of treasuries, especially unless yields rise to a higher level to bring in more bond investors.
Yeah, and I think a lot of people are assuming that if this market route continues in the stock market, that a whole lot of money is going to flood into treasuries, and that's where the demand is going to come from. And, something I've been saying for a long time is we're going to reach the point someday where those correlations flip positive and you see bonds and stocks selling off at the same time. And the reason I say that is because we have wound the prices of both stocks and bonds up to just historically extraordinary levels. And although there is normally an inverse correlation between stock and bond prices, if you've artificially pumped the price of two different things up to astronomical levels, it doesn't really matter what the historical correlation is. You've just pumped two big balloons full of air. The air starts coming out, and both balloons are going to get smaller. And I think a lot of people just lose sight of. You talk about it a lot on your show, I know, but it's amazing the big networks don't seem to get it. Is we've inflated the whole economy up with central bank largesse, with a whole bunch of quantitative easing that has allowed us to just super inflate these bubbles in both the stock and bond markets. Those bubbles are already full. We don't have a lot of ammunition left to fight the next crisis. And I think the big fear that's on everybody's mind, and I don't mean incipient like tomorrow, but everybody who's got half a brain knows sometime in the next 10 years you're going to have another financial crisis. What are we going to use as ammunition to fight the next one with if we're already north of $4 trillion on the Fed's balance sheet and we've already got historically, almost nothing yields on treasuries? So we're in a position where we can't defend against the next crisis, and we're overdue for at least some kind of bear market. And I think that's what's really got everybody on the edge of their seat is when things start to fall apart, how bad could they get? And how ready is the Fed going to be? And how able is the Fed going to be to come to the rescue this time when they've kind of already shot all their bullets?
Yeah, plus the U.S. government is so reliant now on capital gains taxes for people selling stocks, bonds, and real estate. So they're used to those higher asset prices and people cashing out for big profits. So when the U.S. Treasury had a huge loss in tax revenues during the 2008 financial crisis, and I think there's the argument to be made that that was one of the major reasons why there was a huge intervention for the QE program, the bailouts, they call it the wealth effect, but it was really just, we need to inflate the asset prices so we can get more government tax revenues back in.
Well, and as you say, there's a huge amount of capital gains that have just come from housing gains. And what people forget is we don't know if the secular bond bear market has already started or if it's going to start in the next couple of years. But, someday it's coming. When you get to a period of secularly increasing interest rates, you don't have big capital gains in real estate anymore because the affordability of real estate is all about what the monthly payment is. And if interest rates are going up, the same monthly payment as time goes on, buys less and less purchasing power. The only way that you can allow the price of real estate to increase is if wages increase so dramatically that you overcome the effect of those higher interest rates. And that's going to be an awfully tough bill to fill. So it's very likely that we won't have these massive capital gains. And as you say, eventually what we're going to get to is the point where the yields on treasuries are moving up, not because the economy is healthy, but because there is more and more doubt about the creditworthiness of even government issued securities. And when that starts to happen, and particularly if you look at all of the things that are threatening the US dollar's hegemony over the global financial system, if the dollar were to lose its reserve currency status, which is a topic very near and dear to my heart, all of the sudden, you would have a situation where the U.S. can't sell treasury paper to foreign buyers anymore because they don't want it and they don't need it as central bank reserve assets. And now you can't refinance the treasury debt. So you can't, first of all, interest rates are going up. You can't afford just to pay the debt service to continue to cover and refinance the existing debt, but you can't even find buyers without a dramatically higher yield, which means a dramatically higher cost of borrowing if you lose that reserve currency status. And as much as there have been warnings from all over the world, you saw Europe even, okay, when you had Russia and China criticizing U.S. foreign policy, saying you're risking your own reserve currency status, it was understandable that a lot of people didn't put a whole lot of credence into that. It's what China and Russia say. They've been kind of political enemies since the Cold War. Big deal. Now you got Germany and the European Union coming out and publicly saying we're going to create an alternative payment vehicle to bypass the SWIFT payment system because we're sick and tired of the United States government abusing its authority over the dollar and weaponizing the world's global reserve currency as a coercive, influence tactic in order to impose sanctions unilaterally on countries like Iran and Venezuela, which have not been sanctioned by the UN and which European companies are, entirely legally entitled to do business with. So it's a situation that eventually in the long run, and you and I tend to really think about the long run for the country. It's a really scary proposition as to where we're headed as we get to much higher cost of borrowing and higher treasury yields and less demand for treasury bonds. But the thing is, smart guys like you, I mean, for as long as I've known you, you've been talking about this problem because you understand how big of a deal it is. And what happens is forward-thinking people like yourself end up losing credibility in the eyes of the simplest people because it's like, well, yeah, Jason's been talking about that for years and it hasn't happened yet. Well, you know perfectly well as I do, it has to happen someday, and it's a really big deal. But if it doesn't happen for several years, people just tune out and they don't care anymore. And we're going to have a really rude awakening someday. It's coming.
Well, I think what happens, Eric, is the governments, we don't know exactly what they do. And sometimes they release a press release, but the economic and political elites behind the scene, the people running these governments and central banks and, globalist organizations like the IMF and World Bank and Bank of International Settlements, they're just willing to change the rules. So the people who are making these comments that the system should collapse and this and that, they're not understanding how easy it is for the people behind the scenes to just change the rules on them. And that's, I think, why things have been postponed a lot longer since 2008. Also, tens of trillions of dollars in extra money and credit has been printed. Like you talked about the US's balance sheet. Well, look at the European Central Bank. They weren't supposed to even be allowed to do QE initially. And now their balance sheet's over 5 trillion. The Bank of Japan, their balance sheet's over 5 trillion. I think now they have more assets in their balance sheet than their GDP, right? Didn't that just come out this week? The Swiss central bank ran a euro peg for all of 3 years, and then they created hundreds of billions of dollars out of thin air, and they're a technology hedge fund. If you believe some of the stuff that the Real Vision television interviews with Kyle Bass are saying, China is basically a total money laundering, counterfeiting. They're hyperinflating their currency, laundering it out of the country, and then buying assets all over the world with it. This is like a movie. I mean, this is a fictional movie. Danielle DiMartino Booth even mentioned, She even mentioned that some of her contacts at the Federal Reserve, and I'm not sure how serious a conversation this is, but she worked in the Federal Reserve, and she mentioned that some of her contacts are openly discussing a debt jubilee.
It's amazing. Steve Keen talks about a debt jubilee, and as much as it doesn't normally match with my ideology, if you will, Steve Keen's version of it makes more sense than I've heard anywhere else. I don't know if you're familiar with it, but what
Yeah.
Steve has suggested is he said, look, what you need to do, because there's you've got to force private debt to go down. So it's not fair to just forget about debt. He says you've got to have some kind of government money printing thing where everybody in society gets a huge check. And the rule is if you have debt, you must use this money to pay down that debt. If you didn't have any debt, you get to keep the money. But everybody who had debt has to use the payment in order to pay down the debt. So you're basically diluting the currency by printing more money in order to force everybody to pay it down. And the few responsible people that were not over indebted end up getting to keep all or part of the money. At least that's a reasonably ethical way to do a debt jubilee if you're going to do one. But the notion we're talking about debt jubilees, it's amazing. And what else would you expect at this point? We've gotten to the point where we're addicted to just unreasonably low treasury yields, and quantitative easing is what got us here. How is this unwind going to work? As you said, we're seeing all these problems because what has happened? The Fed, which of all the central banks in the world, the Fed's the only one that's even doing quantitative tightening, and it so far has unwound less than 10% of this massive balance sheet expansion that's occurred over the last 10 years. They took 10% off the top, and that would be like 2% off of the global central bank, balance sheet expansion that's occurred across all the major central banks in the world. And that's causing problems. What happens if we actually wanted to unwind this thing? And how far can we go, especially as the cyclical economy is eventually going to get us into a recession? What are we going to use to fight that next recession with if the central bankers have already spent all of their ammunition? And the answer is you have to go to more and more extreme things. Quantitative easing, other than in Japan, was unheard of. It was that crazy, only the Japanese would actually try it. It was so controversial and so, over the edge. Well, then it was everybody. Right now, the notion of a debt jubilee just sounds like something so anti-capitalism that it could never happen. Well, I wouldn't say it could never happen. The thing is that a debt jubilee is really going to hurt some people that are very well heeled and have a lot of influence. So what I start to look for is, okay, what is the form of debt jubilee that the people who are on the know can position themselves in order to not be the ones who take the hit? And how would that be organized? And what are the signs that I could watch for to see when the most politically connected elites in society are shuffling their portfolios? What does that tell you in terms of what might be coming? But we've gotten to the point where reckless government policy has gotten us into a corner that is going to be next to impossible to get out of. As you know, you can't service the debt. I mean, we've got approximately the same cost of debt service now as we had 10 years ago, but interest rates are a third of what they were 10 years ago. If we go back to normal interest rates, we triple the cost of borrowing. We can't afford that. It's impossible. So what do you do?
And the debt is also larger too. It doubled under Obama, right? And Trump, with his supply side economics, especially if he gets another tax cut in, I mean, I wouldn't be shocked if Trump wins a second term. And then the debt is, by the time Trump leaves office 6 years from now, if it's $30 trillion or over $30 trillion.
And we've been on this trajectory where every 8-year president doubles the national debt. You can't double something too many times over before you just hit impossible limits. And I have been saying for years that day of reckoning is coming. I predicted it would be during this presidential term. In other words, assuming that, I don't mean in the next 2 years, but in the next 6 years. I made a prediction in, 2012 or so. I said, whoever gets elected in 2016, if they're in it for 8 years, from 2016 all the way to 2024, sometime in that window of time, we're going to hit the point where we just can't go any further and everything is going to come crashing down. It seems like, we're not there yet, but that window is rapidly, I hope I'm wrong. I hope it lasts a lot longer than that, and we somehow get out of this and the economy keeps working. But we've backed ourselves into a corner, and it's amazing to me how few people are willing to acknowledge it for what it is.
I hope you're wrong too, and I hope I'm also wrong about my prediction that the U.S. is headed along the lines towards a violent ideological civil war, because things are escalating on both sides really quick. I mean, look at what happened during the midterms with the voting results. Things are just more and more polarizing.
Well, and the thing is that a civil war almost never starts one day when there's some event. What you have is increasing levels of civil unrest and situations of conflict, and it gets worse and worse and worse until one day you realize, oh my God, we're at war. You've already got it, Jason. We've reached the point, and people who are in it every day, they don't realize it. But if you had said to somebody 10 years ago, listen, here's what's going to happen. In 2018, you're going to be at a cocktail party and you're going to be afraid to honestly express your political views because there's a very realistic possibility that somebody at the cocktail party will become violent and attack you and hit you over the head and knock you unconscious with a baseball bat in the parking lot on your way back to your car after the party. And you'd say, that's the most ridiculous thing I've ever heard. I would never go to a party that where uncivilized people like that would hang out. Well, who do you think I socialize with? Well, we've gotten to the point, Jason, where that kind of thing is not unheard of. And although it certainly doesn't happen all of the time, I can tell you I would not express my political views openly in the company, in a social setting, in the company of people that I don't know, because I'm never sure if somebody who thinks that it is reasonable to express your disagreement through physical violence is going to be there. And we've got more and more people like that in society. You'd never used to have that. And it's pretty common now.
Agreed. And not only that, people are trying to ruin each other's like reputation financially, like misconstruing comments. It's just getting really out of control. I mean, especially with the stuff on social media, it's almost getting to the point where someone, like, if they want to protect their job or their income or their business, almost has to delete their social media account because people are going back through, old social media posts from 6, 7 years ago. If someone was a teenager and they said something, they can get in trouble. But I want to transition now, Eric, because we kind of got off topic here. So you talked about the risk parity trade with stocks and bonds both going down. So I know you've interviewed Christopher Cole. He's the vol expert. He has a vol hedge fund. So in your opinion, what would happen then if stocks and bonds went down together enough percentage? Would that blow up the leverage short volatility trade in stocks and bonds and commodities and all these different asset classes that has been created to try to generate income?
Yeah, and I think that the unwind of risk parity is really one of the biggest systemic risks that we have, because if that correlation breaks down, really, it's not a discretionary thing at that point. As soon as that hedging mechanism is not working anymore, then the institutions that have that trade on really don't have any choice but to take it back off. Well, how do you take it off? If you are long stocks without leverage, okay, you got to sell some stocks, and a lot of stocks, you sell a lot of stocks, there's a stock market crash. But if you're long bonds with a lot of leverage and you've got to unwind all that leverage, now you're really, really selling a lot of bonds at the same time. So it could really become a self-reinforcing crisis. And it's not like a panic like you have in a retail stock market crash where people see prices and they freak out and they sell at the worst moment. It's investment professionals saying the correlation that existed in markets that was the basis for putting this trade on has broken down. Therefore, we have no choice but to take this trade off, liquidate the positions. That's what we have to do. Well, as soon as that happens, and it happens across the board with almost all of institutional finance in one capacity or another that's into that risk parity trade, it's a massive, massive unwind. And it was fascinating for me to talk to Chris Cole after the February event. And it was like, congratulations, buddy. You called it, man. He's like, no, I didn't. You didn't get it. This was tiny. What I'm predicting is a big deal. This was nothing. That vol blow up that we saw that knocked out all the people in the ETF, that was a tiny little backyard weenie roast compared to what I see on the horizon. And he says, I don't know when it's coming, but what we saw in the vol complex blow up, it didn't involve unwinding risk parity. It didn't involve unwinding all of these implicit short vol trades. It only blew up the explicit short vol trades, people that were levered up and shorting the VIX because of the contango yield that was available there. So he said once you get to the point where it's the implied as opposed to the express short vol trade that's blowing up, it's the whole financial system. It's the global financial system. It's not a few guys that are misusing the VIX ETF. It's the whole financial system that blows up. And he was very emphatic in saying what's coming someday is much, much worse than anything that we saw a taste of in February.
So for a historical perspective for listeners, besides what you mentioned in February, what you described there with taking tons of leverage and going long bonds, that's what long-term capital management did, right? And that was just one firm. That was a bunch of eggheads, PhD economists that raised a bunch of money. Now they did have a lot of counterparty risk, but from what you described and what Christopher Cole has described and other vol experts has described, I even heard a conversation on the Adventures in Finance podcast from Raoul Pal and Grant Williams before they shut that free podcast down, that it sounds like a lot of people in finance are doing this. So it's not just long-term capital management doing this time. It's a lot of professional money managers.
Well, yeah, and I think they're really, what was going on with long-term capital were convergence trades that were a very specialized form of this. They were using more leverage, and they were using leverage in order to have positions that in theory should have balanced each other out, perfectly hedged each other. It was supposedly going to reach this convergence where they were certain to make money in the end if they could ride out a little volatility before they got there. And what happened is once the volatility started, it started kicking them out of their trades, and it was a self-reinforcing vicious cycle, and it got really ugly. It's a different, I guess in many ways it's similar, but the difference is what has occurred all across of institutional finance is basically this risk parity trade, which Ray Dalio really was kind of the grandfather of, which just says, look, if you take the usual equation of bonds and stocks, you can still have your stock exposure, but you can lever up the bond exposure because it has so much less volatility than stocks do. And although you get a little bit more volatility in the bonds, if they're inversely correlated to the stocks, that tends to balance itself out and you end up with better return on total. So what the risk parity trade really involves is a balance between a stock portfolio and a levered up bond portfolio. And it's not the same kind of leverage that long-term capital was using, but the thing is, as you say, it was just long-term capital then. So it's a less extreme form of leverage, but it's the whole global finance community that's doing it. And you can't justify having that leverage unless you can say, well, yeah, we've got the leverage on the bonds and that's volatility. But the thing is, the stocks are inversely correlated. So that means it all balances out. It's beautiful until it stops working. And then you don't have any choice but to unwind that leverage. And everybody's doing it at the same time. And that's where you get a bond market crash. And if you're losing your reserve currency status at the same time because of stupid foreign policy mistakes that, in my opinion, this administration has been making, you're really, really in trouble. And I think that's a risk that we face.
And it also sounds like the leverage short volatility trade, according to Raoul Pal and Grant Williams, is not just in stocks and bonds. It's also on real estate. It's also on different commodities. So they've anywhere that they could pick up a penny, trying to extract some income using leverage and selling some options to get some premium because I guess this goes back to the central banks, right? Because they've all manipulated interest rates down and all people are desperate for income. There's enormous pension fund shortfalls. The largest pension funds in the world, they need 8% per year compounded, and they're getting maybe 1%, a lot of them. So they've been coming up with desperation moves, basically the financial equivalent of a Hail Mary in football. So they've been making these Hail Mary passes, trying to get extra income, taking on excessive risk. And, the odds of completing a Hail Mary are very low. But, for years, these institution professional money managers have been making money collecting premiums with this leverage trade. But, the odds are not in their favor. And yet here they were. For years, they've been making money off of it without it blowing up. But it's a ticking time bomb.
Absolutely. I couldn't possibly agree more.
So, Eric, as long as I've known you, you're an oil expert. I know you've covered the oil market extensively. We've had a really crazy time in the oil market. I think this has been the craziest oil market, they said, in the last like 11 or 12 days in about 30 years. So why do you think the oil market crashed so much so quickly? Do you think there was Iran? According to Professor Steve Hanke, I think he said Iran's currency is hyperinflating against the dollar. Their inflation rate's 268%. Are they dumping massive amounts of oil and mass amounts of oil production onto the market? So why do you think the oil price crashed so quickly?
Well, there's a number of factors that are coming together. First of all, this whole there's a theory CNBC has posited, which is that Donald Art of the Deal Trump has intentionally crafted this ruse to snooker the Saudis into increasing production by pretending that he was going to strictly enforce sanctions on Iran, setting expectations that a whole bunch of Iranian production would be coming off of the market, that causing Saudi Arabia and others to increase production, which they've been very public in saying that that's what they were doing for that reason. Then the Trump administration at the 11th hour says, oh, we were just kidding. We're not really going to be that strict about these Iran sanctions. We're going to grant a whole bunch of exemptions and allow people to continue buying oil from Iran. So the thesis is that President Trump, going into the midterm elections, brilliantly engineered this ruse to trick the Saudis into increasing their production, only to have the rug pulled out from under them and to be told, aha, we're just kidding about enforcing Iran sanctions. I think that probably that has a little bit of exaggeration to it, that storyline. But one way or another, those circumstances were lining up in that way. And then you had this whole Khashoggi murder debacle where Saudi Arabia really lost a huge amount of credibility on the public stage. And it became clear that maybe Mohammed bin Salman was at risk of being sacked by the kingdom in order to clean up the mess from this thing. It looks like so far he hasn't been, but they really were in egg on their face mode and trying to figure out how to recover. And I think that caused a lot of the market to already start to question Saudi Arabia's ability to have a strong negotiating position. And then they announced that they were, pretty much producing as fast as they could and producing all the oil that they were able to produce. And that helped to accelerate the sell-off. And it was finally the news coming out, which frankly should have surprised nobody. But on Tuesday morning, that final sell-off that we saw down to 54.75 on WTI, what brought that about was the news coming out that the Saudi production was now in excess of what it was before the original cut agreement. So the whole OPEC freeze cut deal that dated back to 2016, they weren't supposed to go above a certain threshold, and Saudi Arabia did go above that threshold. Now, why that surprised everybody on Tuesday when Khalid al-Falih, the Saudi oil minister, had said on network television 2 weeks earlier, we've changed our position and we're now producing as much oil as we possibly can, as President Trump wants us to. Why people are surprised after he said that their production increased as much as it did, I'm not sure. But that's kind of what spooked the market all the way down. We had massive, massive inventory builds way beyond analyst expectations. Another one just today, as we're speaking on Thursday, we had a 10.7, I think it was, 10 point something million barrel build on inventory against analyst expectations of a 3 million barrel build. So huge builds in inventory, which are bearish, along with increasing production. I hit 11.7 million barrels of U.S. production. That's an all-time record. It's up another 100,000 from just last week, and last week it was up 400,000. So you've got a lot of bearish fundamental news, but also I think it's this Trump, Saudi Arabia, Iran thing. And at this point, I think that's pretty much played out. So I wouldn't be surprised if the 54.75 low that we saw on Tuesday morning was at least a short-term bottom. We if we were going to dramatically sell off even lower, you'd think that the catalyst would have been this just hugely bearish inventory report. But if the inventory report didn't do it, it seems to me like you'd probably need another significant catalyst to really push us to a lower low. Maybe that will come. Maybe we'll get more bearish fundamentals next week. But so far, I think we're probably going to hold this level, and there's a chance of it. I mean, we were so oversold. There's got to be some kind of bounce, even if prices are headed lower. We're way overdue for a bounce. And as you said, I think it was something like 11 or 12 consecutive trading days of down closes. That's the first time ever. The record was 9 previously, and we eclipsed it by several days. So this is a really big deal.
Well, when a trend is established now with these high frequency trading algos, they're going to extrapolate and push the trend even further. Although from what I hear, some of these high frequency trading algorithm programs, some of them are programmed based on standard deviations. So if a move is more than 2 standard deviations, they start to shorten the position and then reverse. So we will see if that's correct. Then some of these trading programs that were shorting oil the last 12 days are going to start reversing the lower oil goes. But I think overall, Eric, that the global economy really needs oil kind of in a Goldilocks trading range where oil prices don't go too high and they don't go too low, because if they go too high, then too much supply comes online, the consumer can't afford it and starts to cut back. And if oil prices go too low, then the producers of oil potentially go bankrupt. The national oil companies that need the oil revenue for their social programs and to balance their government budgets, they could go bankrupt. There could be social unrest there, political revolutions, etc. So somewhere in the middle with a lot of volatility is kind of what the global economy needs. I call that the Goldilocks oil price. But the oil price is very volatile. I think you've talked about this on your show. There is a lot of manipulation in the oil market. I think even mainstream financial journalists like Isabella Kamenska have talked about it. So, I think that adds extra volatility along the way in between that trading range.
I agree. And Izzy Kaminska is absolutely brilliant. She's one of my favorite mainstreamers.
Yeah, except she loves Larry Summers, but let's not talk about that. I got in a Twitter war with her for about 45 minutes a couple of years ago. I don't want to talk about it.
I didn't know that. You've crushed my image of Izzy Kaminska. Okay.
Well, she's a smart woman, and she may know a lot about the oil market, but she has an unhealthy affection for Larry Summers. That's all I'm going to say.
Okay.
So let's transition now to the stock market. So, the stock market, it seems to me there's a lot of chop. The VIX is up. A lot of these companies, there was about 7 companies that were responsible for the majority stock market gains. There was a lot of money going into these passive investing ETFs. I think you've had Jesse Felder on your show to talk about this. I had him on over the summer to talk about this. Do you think that now that some of these companies, these larger tech companies are slowing down, missing earnings, do you think that that's going to putting in a topping process for stocks?
Yeah, I think we've been in a topping process for several months, and I think probably the top is in, and I won't be surprised at all if this 10-year bull market, the longest bull market in history, is finally ending, and we're at least into a cyclical bear market. The thing is, what we've seen is that 10% sell-off, which is traditionally the buy the dip number. And of course, you're going to see at least some kind of a bounce. Nothing goes up or down in a straight line. The really big tell is going to be whether we get to new all-time highs, which I'll be astonished if it happens this year or even into next year, or if we end up moving back below 2,600, which was the low, at least on this recent cycle. And then I think the earlier cycle down, I think was 2550 was the low. As we move to lower lows, that's really going to confirm that a bear market is on. At this point, if you really, really wanted to stretch, I don't know when this episode is going to air, but as we're speaking on Thursday the 15th, if you look at the S&P chart, you really got to kind of turn your head crooked and squint, but you can find an inverse head and shoulders where a right shoulder is forming that could be, what you need in order to draw a chart that projects a move back to all-time highs. I would say no way, but I have been proven wrong before. I really felt this bull market should have ended a few years ago, and it's continued to astonish me. So I'll be even more astonished if we actually get to a new all-time high. I think we go back up into the 2800s again, and it's some point we find a failed rally and we move to new lower lows. And it's the lower lows that will really confirm it for me. Until then, there's room for this to go either way, but I'm leaning toward bear market is on.
And from the data that I've seen, it's the institutional money, the professional money managers who are fading the stock rally. So every time the stock market does have rally, they're selling more and more of their positions and getting out. But it seems that the retail money is still coming in.
Yeah, and that's the way that it usually goes. I mean, the smart money is selling to the dumb money at the end of the bull market. And I hate to say it, but that's probably what's going on. And that's the reason that you'll likely see some churn here. Remember, there are a lot of seasonal effects at year end. Year end rallies are not unusual. So, to see a year end rally up to 2850, 2900 even, wouldn't be completely out of the question, but I'll be very surprised if we make it to new all-time highs.
So, in the remaining part of the interview, let's talk about your book and also Bitcoin and blockchain. For our listeners who missed it at the beginning of the interview, your new book is called Blockchain, The Death of the Dollar and the Rise of Digital Currency. So, why did you decide to write a book? Because I've had a lot of my other guests on who've written a book and they said, they've spent they've had to get up at 3 or 4 in the morning if they have a day job. It's a lot of extra work. Sometimes it takes years to do. So, why did you decide to write a book and why now?
Well, I can certainly attest to that. Nobody makes any money writing books. You've got to be passionate about wanting to do it. And the reason that I'm passionate about this subject is, first of all, it's not a book about Bitcoin or about blockchain. The title is Beyond Blockchain, and it's The Death of the Dollar and the Rise of Digital Currency. And the reason that it's a change of subject is I think that I made a mistake that, frankly, the entire finance community is making, which is people are lumping digital currency technology and cryptocurrency together into one thing. So you take the invention of double spend-proof digital cash, which was invented by the cryptocurrency guys. Distributed ledger and double spend-proof digital cash are breakthrough inventions that are going to change the course of human history. But the analogy that I like to use is, imagine that you had somebody invent a new voting machine that works way better than anything we had previously. It eliminates voter fraud. So even in Broward County, Florida, everything is completely above boards and nobody can cheat and all the votes are counted and so forth. Well, obviously, any sane person would welcome that invention. Well, now imagine that the guy who invented it starts staging his own elections because he figures since he invented it, it's a better way. He should be in charge of the elections. Okay, wait a minute, time out. Inventing a better voting machine doesn't entitle you to stage your own elections. Well, what's really happened with cryptocurrency is the guys who invented digital currency and digital cash, which is a really, really important invention that can change the entire future of the global monetary system, decided to go out and stage their own elections. And in this case, the analogy is coin their own money. Rather than saying to the government, hey, here's a better way, you should use this instead of banknotes, they said, we'll start our own currency system and promote it as an alternative to government-issued money. For thousands of years of recorded monetary history, governments have never allowed anybody to do that. And cryptocurrencies have been getting away with it for 10 years. So my hat's off to them. As a libertarian, I love the idea of private issued currency competing with government currency. But I'm afraid that as much as I love that idea, the people in the crypto community who are assuming that they're going to get away with this forever, and it's they think the government can't do anything to stop it, and that's just nonsense. The government could very easily outlaw Bitcoin and other cryptocurrencies, and although it's difficult to outlaw a protocol on a network, it's very easy to outlaw the exchange of fiat currency for digital currency or for cryptocurrency. As soon as you do that, you've effectively defeated the way that most people use Bitcoin and other cryptos today. So I am very skeptical of the long-term future of cryptocurrencies, and that was causing me to make the same mistake that I contend the entire finance community, except for the crypto buffs, is making, which is to throw the baby out with the bathwater and say, digital currency, I'm not taking it seriously. Digital currency is going to change the world, Jason. It's just that cryptocurrency might or might not be part of that equation. So what the book is really about is separating the idea of digital currency from cryptocurrency, and it argues why I'm convinced the central prediction of the book is that the US dollar will be replaced as the world's global reserve currency by a digital reserve currency. Now, that could be the US dollar, the digital dollar, if the US government gets its act together, or it could be another government's currency, or it could be a cryptocurrency, which is what the crypto guys think is going to happen. I try to cover those things with as unbiased of a view as I can in the book and say, look, these are all possibilities, but what we need to focus on is the opportunity for the world to re-engineer the fractional reserve banking system and dramatically improve the global monetary system is staring us in the face, and digital currency is going to change the world. It really is. The thing is, we need to stop assuming that digital currency means cryptocurrency. It doesn't need to mean that. You can have central bank issued digital currency. Now, central banks are operated by governments, which means they operate at the pace of government. So even though cryptocurrency's been around for 10 years, they're just starting to get their heads around what it is. Eventually, they're going to figure this out. And my prediction in the book is the reason that they'll figure it out is exactly the same as what happened on October 4th, 1957. Before that date, everybody knew about space travel, little green men from Mars, ray guns, flying saucers. It was kiddie stuff. It was science fiction. Nobody took it seriously until October 4th, 1957, when the Sputnik satellite orbited the Earth and the U.S. government said, holy shit, it's not science fiction anymore. It's science fact, and the Russians are way ahead of us. What are we going to do? I am convinced, Jason, that China and Russia are already working hard quietly in this. People's Bank of China filed more digital currency related patents than anybody else in 2017. They're actively hiring blockchain engineers, but they're not talking about what those blockchain engineers are working on. Something's going on here. So I think that China and Russia have already figured out that if your agenda, and it's certainly their agenda, they've been very open about this part, if your agenda is to dethrone King Dollar as the world's global reserve currency, and you're looking for a way to do that, the logical conclusion is obvious. One of your best tactics is to create a government-issued digital currency system. And what I describe in the book is you can take that a step farther. Russia and China, if they were to create a digital yuan or a digital ruble, probably wouldn't get very far, and they know that. But if they created an independent central bank, might be headquartered in Europe just for the sake of neutrality, which created a gold-backed digital currency. So it actually has backing with gold bullion behind it as opposed to just another fiat currency. As much as the crypto guys like to talk down fiat currency, crypto is a better form of fiat currency. It is a type. I mean, it's not fiat in the sense that it doesn't have any government decree. It's less than fiat. If it got the government decree that said this is the official currency of the land, crypto would move up to the level of being a fiat currency. If you start thinking about a gold-backed currency, you're not in the world of fiat anymore, and you could have tremendous advantage. I think Russia and China have already figured this out, and I point out in the book a whole bunch of evidence, admittedly circumstantial, that tends to suggest that they're already working on this. So it's not a book about blockchain or Bitcoin or anything else going on with cryptocurrencies. It is a set of predictions about how digital currency is going to change the course of history over the long run, and these predictions are 10 or 20 years out. I certainly don't think that the US dollar is going to be replaced as global reserve currency next week or next month. Within 10 to 20 years, I think it's going to happen, and I think it's a digital currency that's going to take the title of reserve currency away from the dollar.
And you also have the economic and political elites of governments and Wall Street. You have them attempting to maybe hijack some of these cryptocurrencies that are supposedly, uncensored. You cannot censor them. So you have Ben Bernanke and Bill Clinton on Team Ripple already. So you have people who have been profiting off this, unjust, immoral system of counterfeiting and low interest rates and credit creation to favored friends. And, they're joining cryptocurrency teams. So that's a red flag to me when you see people like that go to certain cryptos.
Well, and I'll give you another one, which is if you look at the cryptos and you say, imagine that you're China and Russia, and you're doing the evaluation of cryptos from their perspective. What you should conclude, and I'm convinced that they've already figured this out, is it's not just the currency system; it's the digital sovereign bond market that's going to really be the game changer that allows you to take the title of global reserve currency away from the U.S. dollar. How do you best build a global digital sovereign bond system on top of a cryptocurrency, and which cryptocurrency is best suited to that? The answer is smart contracts in Ethereum are a whole system on top of the Ethereum cryptocurrency for building sophisticated financial application systems. Now, it's not really capable enough to build the distributed to build the digital sovereign bond market of the future that I envision in my head, but they're on the right track. They've got the right concepts. They're well on the way to being able to do that. So, who does Vladimir Putin, the president of one of the biggest countries in the world, meet with and have spend like 2 hours behind closed doors in a private meeting with? Vitalik Buterin, the 24-year-old Russian Canadian inventor of Ethereum. And supposedly when people asked Buterin what this was all about, he says, "Oh, well, he just wanted to congratulate me on being a successful entrepreneur at a young age." You don't sit behind closed doors for 2 hours with Vladimir Putin being congratulated. There was more going on in that conversation. So is Russia looking at Ethereum as the basis, the platform on which they might build a digital currency system and a digital sovereign bond market designed to upstage the US dollar? Well, they're talking to all the right people, aren't they? It's a small world.
It'll be interesting. It's kind of a James Bond movie with all this cryptocurrency, and the mainstream media is not helping things because they make anyone who looks into crypto as a total criminal. And I guess as it becomes more mainstream, this will change. But yeah, there's a lot of innovation going on behind the scenes. I was at a cryptocurrency conference earlier this year. There's a lot of big technology companies spending big research and development dollars on it. They haven't switched over to any of this stuff yet, but in the next 10 years, you said it's going to take 10 years. Well, we have a lot of big technology companies over the next 10 years that are going to be integrating blockchain a lot more.
Yep, and this is something that I also talk about in the book is as much as everybody's all excited about blockchain, everybody's talking about blockchain technology. Blockchain itself really is a very flawed and limited implementation of distributed ledger. There's this thing called proof of work, which is just incredibly inefficient. And that's the reason that you've heard these stories about the Bitcoin cryptocurrency consuming more electricity than entire nations. It's because of this proof of work based blockchain. The thing is, this is technology, Jason. We're going to break through the proof of work barrier and come up with a better way to build a decentralized distributed ledger system. When that happens, it's going to be like 100-to-1 performance increase over anything that blockchain can do. So there's a coming breakthrough. Right now, blockchain, as much as all these people are getting so excited and they love it and blockchain forever, blockchain sucks. The thing is, we just haven't quite figured out how to fix it yet. Think about going from propeller to jet engine on airplanes and how much that enabled. The breakthrough that's like the jet engine is going to be the fully decentralized distributed ledger system that does not rely on proof of work, and it's going to change everything. When that happens, you're really going to see things go into overdrive.
And to add to your analogy there, if I'm not mistaken, during that transition process, there was a lot of planes that crashed and burned. There was a lot of people that put their own lives at risk and died. So,
well, and you're seeing things like this happen. We saw Ethereum as a really well designed cryptocurrency system. I think it's one of the leaders, if not the leader, technologically in the cryptocurrencies. They had a little bug that left hand didn't know what the right hand was doing. They made some code changes, something. The guy developing the application on top of the platform didn't know what the other guy was doing, and somebody stole $50 million. Oopsie. We're still at the infancy of these things. And what I say in the book is, if you want to go and speculate on the price of crypto tokens, which frankly I think is a foolish undertaking, then you need to pay attention to all of these details because you certainly care about a security issue like Ethereum losing 50 million bucks. But in the grand scheme of things, it's not important. It's just like, who cares how safe the Wright Flyer, the world's first airplane, was? It's not important. The Wright Flyer proved it was possible to make airplanes fly, and it set the stage for an industry to advance and evolve technology over time. We don't care what the Wright Flyer was like or the fact that it didn't even have a pilot seat. We care what the Airbus A380 and the Boeing 747 are like. When we get to where we're headed, we're going to look back at blockchain and we're going to laugh like we laugh at a picture of the Wright Flyer and say, oh my God, people thought it made sense to build anything based on that. That's crazy. Well, right now, it's the best anybody's been able to figure out is this proof of work algorithm as a way for making the blockchain distributed ledger fully decentralized. Already, we've got something called permission distributed ledgers, which are not fully decentralized, and that has its share of ups and downs. But if you can give up centralization, you can go thousands of times more faster and more efficient than you can with blockchain. Someday we'll get to the point where you can do that in a fully decentralized way. Somebody will figure out how to break this proof of work barrier, just like we broke the sound barrier with aviation and had supersonic flight. I don't know how long that'll take, but I'm sure we'll get there. So this whole space is developing very quickly. And one of the things that people don't understand is, even though they all talk about, oh, blockchain technology, it's so great, it'll have so many applications other than cryptocurrency. Really, to use blockchain because of the need for mining and the need to incentivize these miners to burn up all kinds of computing cycles, in order to use a proof of work based blockchain distributed ledger, you really need to have a currency system because it's only by issuing new currency that you can incentivize the miners. Once you solve this proof of work barrier, which is a technology barrier, you won't need mining anymore. You can get rid of the whole concept of mining, and the distributed ledger works without any miners. And it doesn't have that overhead requirement. You don't need to incentivize anybody because mining isn't necessary anymore. When you get to that point, suddenly that vision of distributed ledger, which is the generic name for things like blockchain, will have so many applications, it'll be off the charts. The reason people talk it up and they think it's got all these applications is because, in theory, it ought to, until you figure out that, oh, but who's going to pay the miners? That's where we're going to get the money from. Okay, it's not going to work. We're going to solve that problem. And the way you solve it is by getting rid of proof of work.
It's going to be really fun watching this all transpire.
It's going to be amazing, and what I'm trying to accomplish with the book, I'm not down on cryptocurrency. I think cryptocurrency is a fantastic innovation. It's a great idea, but I want to do two things. I want to get the crypto guys to realize that there are threats that they're not taking seriously enough that could get in the way of their cryptocurrencies really becoming what they want them to become. But mostly, I want to get the whole finance industry to wake up and realize that even if you're a crypto non-believer or a crypto skeptic, whatever you want to call it, don't worry about crypto. Digital currency technology is going to change the course of history. It's going to be a really big deal. I don't think crypto is going to play that big of a role in it. I think it's more likely to be government-controlled digital currency. And I don't have any fantasies about the government itself, having programmers that are smart enough to do this. What it will come down to is contractors will recognize that looking at what governments would like a digital currency to look like, and on speculation or under contract, private contractors hiring up lots of really smart engineers, probably people that have worked on cryptocurrencies, and designing digital currencies that are government issued or central bank issued digital currencies. It'll be the private sector that engineers and builds them, but they'll be owned by the government. And I love the idea of private issue money competing with government money. It tickles all my fancies as a libertarian. But in the world that we live in, I just don't see it being allowed. And it's not true that that governments are powerless to outlaw Bitcoin. That's nonsense. They can do it very easily.
Yeah, the government likes to maintain its monopoly on money. They do it with force. They do it with guns. They do it with the tax laws. Look at the guys who tried to do digital gold or e-gold first. They put a centralized location, right? One was in Costa Rica. There was a Liberty Dollar. There was a handful of attempts prior to Bitcoin, and the mistake they made was a centralized location, and they got busted for money laundering, taking drug money, stuff like that.
Well, and there is a legitimate difference, which is with a decentralized design, there's no one guy to go after. There is no one guy in Panama or wherever it was with those private currency systems that were centralized. So it's harder. But it's ridiculous to say that government is powerless. What a lot of people in the crypto community think is they think, well, you can't outlaw the existence of a protocol on the internet. It would be easy to hide it, even if it was illegal. So therefore, Bitcoin, lives forever. Well, it may very well be true that it would be almost impossible to legislate the Bitcoin network out of existence, but it's very easy to impose draconian controls that make it next to impossible for anybody except for, hardened criminals that are willing to commit felonies to convert fiat currency into cryptocurrency or cryptocurrency back into fiat currency. If you just put that barrier up, you've effectively undone the what most people use these things for, and you've effectively outlawed cryptocurrency at that point. There will always be a black market. I don't question that, but the idea that governments are powerless is nonsense. What governments are is clueless. They haven't figured it out yet. Eventually they will. And law enforcement has figured it out. They know that people use Bitcoin to do illegal things, and they're doing what they can to clamp down on it. But as far as central banks recognizing, as they should, that cryptocurrency is really cool. It poses a competitive threat to the status quo because the vision of the crypto guys could come true. The world could recognize that cryptocurrency is better than conventional currency and start wanting to use that instead of government-controlled money. And what I think the crypto guys are really getting wrong is they're assuming that governments are powerless to stop that once it begins. And that's just not true. The government can very easily put an end to that. And there will still be Bitcoin, but it'll be illegal and only criminals will use it.
And I'm not sure if they've implemented this yet. I know they were talking about it, but New Zealand was talking about requiring that you hand over your smartphone or tablet passwords when you go to their airports if you fly in from wherever. And they're looking for things like your online bank account. They're looking for things like your cryptocurrency holdings on your phone to see if you didn't declare the taxes and didn't pay any taxes on your crypto holdings, that you traded, stuff like that.
Yeah, it's amazing to me that they get away with that stuff, but I've heard that. And New Zealand is a weird customs country. Last time I was in New Zealand, it was funny because the customs people don't appear to care at all about drugs and firearms and the usual things that customs are looking for. They're searching through everybody's luggage looking for wood. And I guess the idea is that wood products that are unfinished might have bugs in them that could get into the ecology and screw up New Zealand, which is a very beautiful place. But it's an interesting culture. They're very serious about the authority of their customs officers, and they do search everybody's luggage. So it's an interesting place.
That's a weird travel story, Eric.
And it's about the wood. We were coming into New Zealand from Thailand, and there's a lot of unfinished wood products on sale in Thailand. So we got taken aside and special search because we were coming from Thailand. So who knows?
Wow. Again, I'll repeat, that is a very weird travel story, and I'm sure someone can make like a funny meme about that, like show me your wood or something like that. Well, Eric, as we wrap things up, you've been gracious enough to give our listeners a free chapter of the book. That's on audiobook, right? The link that I'm going to put in the information section.
Yeah, there's actually, if you prefer to read it, if you go to macrovoices.com/BB for Beyond Blockchain, there's a page there that has a link to either the free audiobook or, if you prefer to just read it as a web page, there's a written form. But the first chapter is available as a free sample either way. And I think you're going to have a link to the audiobook in the notes for your in your show notes, or maybe you want to put in both of the links. I'm not sure.
Excellent. Well, I want to thank you for your time today. Keep up the great work over at Macro Voices, and I wish you the best of luck on your book.
Okay, thanks so much, Jason. It's always a pleasure to talk to you. I'll talk to you again soon.
Please like this video, share it with friends and family, and don't forget to subscribe to the Wall Street for Main Street YouTube channel if you have not already done so. Thanks for helping Wall Street for Main Street pass the 20,000 YouTube channel subscriber milestone despite YouTube censorship. Hopefully, we'll be able to get to 30,000 or even 40,000 YouTube channel subscribers quickly if YouTube doesn't shut down this channel. If YouTube does shut down this channel, remember to also sign up for the Wall Street for Main Street email list that's on the wallstreetformainstreet.com website and will tell you where the videos are going to be uploaded instead of YouTube. Also, if you really like the content and you decide that you want to give a one-time donation, you can go to the wallstreetformainstreet.com website where there's different options for you to do so. Or you can become a Patreon contributor. Thanks for listening, and I look forward to providing my loyal listeners with some of the best information, analysis, and financial education available out there, free or paid, as I work to grow the podcast and also get my educational technology company funded.